This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenivek, live on Bloomberg Radio, television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, we are across Bloomberg platforms, radio, TV, YouTube, and Bloomberg Originals. Carol Massar along with Emily Graffeo. Of course, Tim is off this week. And so we're looking at a market, I got to say, we got stocks down just a little bit, down about 0.7% on the NASDAQ 100. We continue to be consumed, though, by a couple of things, including what we are seeing in terms of Bitcoin surpassing $70,000 for the first time in over 2 months. It's
good relative to how
what?
the last, couple months have been for Bitcoin. And it actually is impressive, Carol, that it's up on a day when the stock market is lower.
Yeah, I thought that was at one point supposed to be like a safe haven. So,
yeah. At one point it was a hedge.
And then it's a risk
inflation.
asset.
Now it's a risk asset. Then it was a gauge for speculative activity.
I feel
Just let it have its day today.
All right, maybe we'll let it have its day. I should say it is also propelled by U.S. Treasury Secretary Scott Bessent's move to push U.S. bond yields lower. We also did have that meeting yesterday, too, with President Trump and those crypto industry leaders. Meantime, we're going to talk a little bit more, though, about the Treasury market. It is definitely front and center. The latest signaling from the U.S. Treasury market. We've got a great roundtable coming up. I can't wait for Emily and I to get to it. Plus, Emily, we've got to talk about Walmart.
Right.
Massive retailer, world's largest, I think, or very close to it, and what that says about consumers.
And speaking of the consumer, we're also going to talk about the housing market. It's all kind of tied together with Amy Rubenstein, CEO of Clear Investment Group, on opportunistic real estate plays.
Yeah, I do wonder if higher rates or the rate environment in any way creates more distressed assets and gives them some opportunities. Also, the owner of the New York Stock Exchange says it's looking at Polymarket's new funding round. ICE CEO will be with us in an exclusive. And then there's GLP-1s. I feel like AI and GLP-1s are two big stories in society and also in the market that we've talked about for the last 3 years.
Huge forces, reshaping healthcare, reshaping Wall Street. And we're going to get into all of that.
And so many different sectors. So a lot coming your way over the next 60 minutes. Let's get to it, though, with a check on the trading session. Matt Piper is in for Charlie Pellet. Matt, take it away.
Hey, Carol and Lemley, thanks so much. Live from the Bloomberg Interactive Studios, I'm Matt Piper. 2 hours left of trading, and we are still seeing a bit of a drop on Wall Street for your Thursday. We do check the markets for you all day long here at Bloomberg. Let's take a look. The Dow is down more than 1%, or 570 points. The S&P is down 47 points. The NASDAQ is down about 250 right now. The Bloomberg Dollar Spot Index is at 1193. The 2-year yield is up 2 basis points. The 10-year yield is up 5. So is the 30-year yield. We don't always talk about that, but that one is the primary focus of the accelerated buyback that we've been talking about with Treasury Secretary Scott Bessent. Gold right now is up at 4,520. The dollar is little changed, but Bitcoin is trading above 70,000 for the first time since June. Bitcoin right now is up $72,660. A rise in oil prices following President Trump's latest threats to Iran. Brent is at $93 a barrel. WTI is just shy of $88. And as Carol said, we are looking at Walmart today. Its quarterly sales fell short of expectations. The company's pharmacy business was hindered by federal negotiations that led to lower drug prices, and shoppers spent less per trip during the quarter. Walmart shares right now are down about 10.5%. We're also looking at Alibaba. Alibaba's profit diving 75% after AI spending hit $10 billion. The company reported a 9% jump in revenue, but net income did tumble. Alibaba shares right now are not doing actually too bad. They're now right now up about 0.4%. And global luxury brands are facing a deepening sales slump in China, with sales at the 25 biggest luxury labels dropping more than 10% in July. Brands like Louis Vuitton and Dior recording double-digit sales drops, while Hermes swung from gains to declines. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Matt Piper, and that is a Bloomberg Business Flash.
From Hermes to Walmart, we do it all. That's for sure when it comes. Matt, thanks so much. Hey, Treasuries, U.S. Treasuries falling a day after the Trump administration's surprise decision to increase buybacks of longer-dated bonds, showing the move did little to counter angst about the surging U.S. government debt that pushed some yields to a 19-year high. Meantime, I love this story on the Bloomberg. We talked about it on our call. Market participants are warning that a lack of predictability when it comes to the U.S. Treasury's debt management strategy could ultimately portend higher borrowing costs. There's a lot going on. The U.S. Treasury Secretary Scott Bessent addressed some of this and the Treasury's actions yesterday earlier from the White House.
Anything that happens within a 24-hour period is noise. And, I think that once the market understands that we are focusing on fiscal consolidation and that we are trying to bring the market back into equilibrium in a thinly traded market.
All right, that, of course, was U.S. Treasury Secretary Scott Bessent earlier from the White House. Let's get to it with two of the smartest folks around here at Bloomberg when it comes to U.S. rates, and maybe just all around, to be fair. Our roundtable, Bloomberg Intelligence Chief U.S. Interest Rate Strategist Ira Jersey, joining us from our Princeton News Bureau. Also with us right here in studio is Bloomberg's news rates reporter, Michael Mackenzie. Ira, I want to start with you. You've got some notes out. You've been writing U.S. long bonds yields. Malaise could persist for many reasons. Treasury buyback surprise signals more duration support ahead. Here it is, another day, and we're talking about yields. Where do we go from here? Or do we not really know?
Yeah, so I think we're going to just see more volatility. We don't know what Scott Bessent and the Treasury Department's going to do in terms of, look, I don't even call it liquidity support anymore, because if they're going to do significantly more than what they've already, kind of said, another $2 billion, Scott Bessent today did say that maybe they're going to do even more than that. So if they start doing another, $16 billion or $20 billion of buybacks in the long end, you have to start calling that either, Operation Twist or something more akin to that. And, ultimately, if the goal is for them to get longer term interest rates down, they have to do something much bigger than what they've done, because there's still a lot of debt out there. And treasuries now are competing with other debt around the world that now has real yields, which they didn't, 10 years ago when everyone had negative interest rates except for us.
How about cut the debt, bring down inflation? I don't know, a couple different tests. Michael, come on in. You two have been writing a lot about this and what we've been seeing in global rates. What are you hearing? There's a team out, our team also writing out a story on the Bloomberg. Market participants warn that a lack of predictability in the U.S. Treasury's debt management strategy could lead to higher borrowing costs. What are you hearing from the folks that you talk to?
I guess the short takeaway is this is just a drop in the ocean. You've got a 32 billion sized Treasury market. Yeah. You've got a debt to GDP closing in on 100%. You've got budget deficit running at plus 6%. You've got an economy nominally growing above 5%, so it's running hot. It's interesting to listen to Bessent. He actually mentioned fiscal consolidation. There is nothing happening on fiscal consolidation front in Washington. Right. It's not going to happen, period. And this is why the bond market is saying, well, we're going to demand a higher premium to lend money to the US government. And as Ira just said, they're competing with the hyperscalers who are coming today, who will come from time to time with 25 billion drive-by issuance in the long end, which is causing all kinds of concern amongst portfolio managers looking at this suddenly arriving. But real yields, or the inflation-adjusted yields, we had a very strong reception to today's 30-year Treasury tip or inflation bond sale, because it came at around close to 3%, which historically is a great number. But the problem is, all Bessent's really done is taken off one of these kind of hedge fund roles from the past and said, let me just try and knock those shorts out of the market. And that's what he said on TV today. But the problem is the fundamentals tell you that yield should be high. They will stay high. And you're not going to get fiscal consolidation. And by the way, the Federal Reserve still can't get back to its inflation target, and it's been missing it for 5 years. And you're going to hear from Kevin Walsh next Friday at Jackson Hole, who supposedly, doesn't want to tell the market what they want to do and doesn't want to define the framework for what they will do in terms of policy in the future. Right. So you put it all together, and you get back to the refunding announcement that's coming out. Next one will be in November. What's T-Bag going to say to Scott Bessent? I mean, are we now going to rip up the playbook for decades where issuance has been predictable and reliable? it's a bit of a mess.
It's another piece of uncertainty in a market that's already uncertain, especially with Fed Chair Kevin Warsh not really giving a heck of a lot of guidance, Emily.
So, I mean, Mike, you talk to a lot of people on the buy side, a lot of people that have to deploy billions into U.S. Treasury bonds.
Yes.
What are they saying right now? Do they not want to buy this debt? Do they like the higher yields?
One of the issues you have with the 30-year is that it's a very long duration instrument, which is typically insurers, pensions play in that space. And if you look at most bond managers, most of them are happy owning the belly. It's kind of interesting because Bessent today said, these hyperscalers should be issuing bonds in the belly of the curve rather than putting this pressure on the long end. So the long end has been trading, disconnected from the rest of the market. And I think one of the reasons why Bessent came out, and again, everyone's questioning why yesterday, why announce this buyback increase, and today saying we could even go bigger. I think they just don't want to see that 30-year disconnect even further, say, from the 10-year yield. Now, there's been a lot of people in the Treasury market who've been saying, well, I'll underweight the back end, or I'll actually put on a steepener trade. And I guess the reaction yesterday, we saw the 30-year drop by 9-10 basis points. That was really people being cleaned out. And Bessent today said, I could take out the shorts. That's just a short-term thing. The longer-term story is that the long end is going to trade adrift. And if more hyperscalers keep coming in, and here's the big thing. I was talking to a portfolio manager yesterday. He said, Elon Musk and Jeff Bezos, they don't care about where they're issuing hedge bonds. If they need to do $25 billion, they're just going to do it.
Yeah,
and
that's
again,
a great point.
You've got all these factors that are really hurting the long end.
Hey, Ira, just to wrap up, saved a minute for you. I mean, yesterday you said folks are not selling treasuries, but they're not buying either. But, I do wonder, too, what Michael says about the fundamentals underlying why rates have been trending higher. I mean, that doesn't look like it's going to go away anytime soon.
Look, I agree. And when you look at the 10s, 30s yield curve, right, at, 60, 70 basis points, that's actually historically not particularly high, right? You go back before the global financial crisis. I think we have to start thinking about the world in kind of the post-inflation era of 2022 in a much longer time horizon, right? Don't just look at the last 15 or 20 years. You really have to look back over the last 40, 50 years in order to get a better picture of, look, where are we in, where should these yields be fundamentally? But then to Mike's point and something we've been talking about, we're at this point in the supply curve where sell-offs are going to be bigger and rallies are going to be shallower just because of the quantum of debt that's currently outstanding. Scott Bessent can't be the game master for where the 30-year is going to go.
Great stuff, and certainly top of mind for everybody here at Bloomberg and certainly on the Bloomberg terminal. Guys, thank you so much. Really appreciate it. Ira Jersey, Bloomberg Intelligence Chief U.S. Interest Rate Strategist out there in Princeton. Michael Mackenzie, thank you. Bloomberg News Rates Reporter. Both of them read their research and their work on the Bloomberg and at Bloomberg.com. All right, we got to shift on over, Emily, to Walmart. That stock has been down as much as 10% in today's session. We're talking about dropping the most in more than 4 years, that intraday low. Walmart's quarterly sales falling short of expectations. It's a rare miss that's likely to stoke concern about the leading big box retailer decelerating alongside a slow-growing U.S. economy. That caught my attention. Let's see what Poonam Goyal has to say. She is Bloomberg Intelligence Senior Analyst for e-commerce and retail. Poonam, good to have you here. You and your team, you watch a bunch of retail names. You do as well, Amazon included on the retail side. Walmart, though, is watched by everyone. And, walk us through the quarter and what's worrying investors.
Yeah, I think it's really the U.S. same-store sales miss. So when you look at that number and you look at why they missed, I think the miss is largely due to the pharmacy deflation issue. And that issue isn't a one-time issue. It's not going away just this quarter. Last quarter, it was a 100 basis point impact to the comp sales. This quarter, it was a 125 basis point headwind. So clearly increasing. And the worry is for the next 2 quarters, you'll continue to see that headwind, and if trends continue, it could be even more pronounced. So that's what's causing, I think, investor concern. And the other thing is when you look at the comp, right, the comp that Walmart has, a US comp, if you strip out e-commerce, the comp is negative. So what does that mean for the stores business? I don't think negative is so negative because online is supported by the stores. Walmart's online business wouldn't be growing at a 20% plus clip for the last so many quarters that I can remember if they didn't have the store base. So I think they do go hand in hand in terms of the way they operate.
Okay, but what comes next? I mean, how do they navigate this miss?
So the miss is going to be reflected even in the upcoming quarters, which is why you're seeing investors react the way they are. What they can do is push the pedal on price. If you think about where the consumer sits today and just the desire to stretch that dollar further, Walmart's in a good place to do that. They've got tariff refunds and they can put them back in price, which is the intent. So as they press that pedal harder and drive value to their consumers, they should be able to draw in more spend. And that's really what we're looking for. We're looking to see that traction increase as they continue to bring value into the funnel.
So I know you don't say buy this or sell this stock, but when the stock is down 10% intraday, does it feel like, based on your analysis and looking at the fundamentals here of Walmart, Poonam, that it's an overreaction potentially?
Well, I think it's a temporary overreaction in that it's not driven by the underlying fundamental health of the business, right? So the pharmacy deflation isn't something that's related to execution or a miss from Walmart or that consumers aren't buying pharmacy there. So that's not the issue. So the underlying health of Walmart, I think, remains very much intact. That said, it's an issue that's not going away either in the back half of the year. So you do have to be mindful of that. And in terms of, where Walmart trades, outside of the buy, hold, sell, when you look at the Walmart multiple, it's clearly at a premium to where it's traded in the past. And part of that premium is deserved because of its increasing online penetration and growth that it's had. And I don't expect that to slow. So when I think of the Walmart business, I think e-commerce, advertising are going to be two big pillars of it that are going to drive exponential growth for the coming years.
We have to ask you about what the earnings results say about the consumer. I mean, you watch Walmart, but you have a really good read on a lot of other retail names out there. What is the takeaway on the state of the consumer from these results?
I think the consumer is stretched. I mean, especially when you look at the low value, the low end consumer, they are trying to maximize every dollar that they have. And that continues as we move into the most important selling season of the year, which is holiday and back to school. So I do think they're making choices. I think they're making trade-offs. I think they're looking at private label. And I don't see that going away, especially in the current environment that we're in, where gas prices are high. But remember, we're going into heating season. Right, in October. So heats are going to start to turn on, electric and utility bills will go higher. So the consumer will only get more and more strapped if we see the continued impact from higher gasoline prices and oil prices.
I always find it interesting, Poonam, when I see the headline from Walmart, they see continued growth from their wealthier consumers. Is that becoming, this came from the CEO, is that increasingly becoming a bigger part of Walmart in terms of driving, or is it still small?
So I think you have to think about, where is that wealthier consumer coming into Walmart from? My impression is that it's not in the stores, it's in the online channel. So it's a Walmart Plus part of the business that is growing at materially higher rates than its store business. So when you think of the mix and where the growth is coming from, I think it naturally makes sense that it would be a more affluent consumer, because that's who's shopping online and paying for that Walmart Plus membership.
All I got to say is, with Walnut shares down, the trading volume, this was a little bit earlier, but it was like 600% of the 20-day average. So we're seeing a lot of activity, certainly in this one. Interesting perspective. Poonam, so appreciate it. And of course, such an important retailer. Yeah, thank you. We really appreciate it. Poonam Goyal, she's Bloomberg Intelligence Senior Analyst for E-commerce and Retail. Yeah?
Yeah, I mean, you gotta think about how the consumer, even if the more luxury consumer is moving down to Walmart, what does that say about the state of the economy?
Like looking, how to find the best opportunities and discounts. You're absolutely right. Hey, stick around, folks. We continue right here on Bloomberg.
It's 2:21 on Wall Street, live from the Bloomberg Interactive Brokers studio. I'm Matt Piper. A rise in oil prices is sending worries about inflation. A drop for Walmart following its latest profit report is helping drag stocks lower. We do check the markets for you all day long here at Bloomberg. Let's get to the big board. The Dow right now is down 605 points. The NASDAQ is down 276. Both of those are down more than 1% at this hour. The S&P is down 52. The Bloomberg Dollar Spot Index sits sits at 11.93. The 2-year yield up 2 basis points. The 10-year is up 5 basis points. So is the 30-year yield, also up 5 basis points. Iran has dismissed President Trump's threats of economic pain and isolation, with its foreign minister saying it will only increase hostility after Trump threatened crushing economic measures against Iran. That has oil rising today. Brent crude, $93 a barrel. WTI, just shy of $88 a barrel. Stocks we are watching: Moderna, mRNA on the Bloomberg terminal. Shares are pulling back following yesterday's 177% rally. That was the biggest in the S&P in the last 25 years. That happened following highly successful phase 3 trial results for its experimental mRNA-based personalized cancer vaccine. Today, though, a different story. Moderna's shares are down 40 right now. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash.
All right, Matt, thank you so much. Carol Massar along with Emily Grafeo here on Bloomberg Businessweek Daily. Emily in for Tim, who is out this week. Just a few recent housing headlines, right? We had U.S. mortgage rates, Emily, falling for the second straight week to 6.65%. We watched that. We've seen Lowe's cutting its outlook as a soft housing market curbs demand. There's a few others.
U.S. pending home sales sliding to the weakest since the start of the year. And new home applications are below the seasonal trend as pricing stays soft. There's like a lot of dynamics going on, like pricing, affordability,
absolutely,
supply.
It all ties together.
And higher long-term rates and what that means for, where mortgage rates are going.
Exactly. So here to talk about housing, she's got a great, unique perspective. Amy Rubenstein is back with us. She's CEO of the Chicago-based Clear Investment Group. They target real estate investments in the distressed, mid-sized multifamily sector, mostly in secondary and tertiary markets nationwide. And it's great to have her back here in studio. How are you?
Thank you. It's so good to be back.
It is great to have you back. I said before we got started, I'm eager to hear what you have to say about the macro, because there seem to be pieces, snippets where we're wondering.
There's a lot of confusing data, right?
Yes.
Yeah. Mm-hmm.
What's your read?
So demand for apartments or for housing has been very, very strong over the last few years. But that's been really masked by the oversupply that we saw over those years. And so that kept rents fairly flat. And while now we started to see something really shift in Q1, Q2 of 2026. And what happened is construction that was at a very high rate at the peak of 2022 was about 60% down over the last year. And so what's happening now is there's less supply coming online. And so that demand is now finally being unveiled. Mm-hmm. So in just Q1 and Q2, we had absorption that was about double of what new supply was. And so what's really interesting about this is the pricing of multifamily hasn't really adjusted yet. It's still really reflecting that 2024 pessimism, when we're starting to see fundamentals that are very strong and indicating that rents will start to rise and that cap rate compression will start to happen.
So from an investor's perspective, you guys are more upbeat about the outlook, except for those who are renting or that becomes a problem.
Right. So
affordability issues.
Apartment renting is far more affordable than buying a house right now. Mm-hmm. Interest rates are still relatively high. And what's crazy is how high construction costs are. They're 40% above where they were pre-pandemic.
Why is that?
Inflation.
It's just inflation.
It is.
Yeah.
And tariffs.
Yeah. All of that is playing into it.
Okay, so you focus on workforce housing.
Correct.
Tell us a little bit about what is that? Who's getting squeezed in that market specifically?
Yeah. So, the tenant base that we're working with, they're not a rent-burdened tenant base right now. So our tenants are making more than 3 times income on the rents that they pay. But what is happening is the supply of what's coming online, even suppressed, is almost no new supply coming in for affordable housing. Mm-hmm. So it does indicate that rents should start to rise. And that is hard for a population that could be struggling financially.
It's so interesting. And what I do like about your perspective is coming from the investor perspective, right? In terms of, right? That is a big part of our world. But there is a balance of when things get much more, expensive, it squeezes out perhaps a consumer from being able to spend more money. I am curious though, then I guess it's cyclical. And so when prices start to go up, so if you expect prices to go up good for investors later in the year. Will you start to see then another bunch of more supply come on? Would you anticipate? Or is it tariffs and costs are kind of keeping everything in check right now?
We already know what the supply is going to look like through the end of 2026 and through all of 2027 based off of construction starts. It's about 18 to 24 months from when you start construction to delivering that supply online.
Right.
We already know how suppressed it was over the last year. So we are going to have that high demand that's outpacing supply at least for the next year and a half.
Okay, what about bottlenecks to more construction? Like sometimes you look at this environment and you think to yourself, let's just build more, right?
Right.
Is that possible?
Well, this is a problem right now is because costs are so high. So we're buying our properties far below the cost of replacement and we're selling them below the cost of replacement. And so how does new construction compete with that? So it is tough, but there will be a point when supply is going to have to come back.
I have to pull in a question, and we've been reaching out to viewers and listeners to kind of bring them into the conversation. And I know this isn't exactly your world, but I want to ask you, Brendan from Maryland has a question. He says it's so hard to buy a house right now, which you confirmed earlier, and we know all too well, but renovations are up. Do you think it's possible that homeowners are undergirding this economy as they're functionally employers to so many small businesses? So carpenters, electricians, plumbers, and so on. After all, one person's spending is another person's income, right? So is this phenomenon shielding us against recession? What could be the flaws in this line of thinking? Now, I know you're from a different perspective, but do you have thoughts on that as you look at the real estate market overall?
As far as people staying put and remodeling?
Well, you know, if you're remodeling and staying put, right, you're certainly employing people. And so does that kind of make it look like there's more strength in the economy than there really is?
Well, you know, we do have a bit of a shortage right now of construction workers in general.
Yeah, you've talked with us about this.
You know, that was a little bit of deportations and some immigration issues. And so, but there is absolutely room to bring in people into that field, and that could boost jobs, sure.
Amy, when you look at geographies, where are you finding the best opportunistic situations?
We love the Midwest. We're all over Ohio, Columbus, Cincinnati, Cleveland. But we're quite opportunistic, so we'll look all over the place. We look for strong, stable metros.
Okay, so speaking of metros, you recently bought a distressed 300-unit property in Washington, D.C.
Yes.
What was attractive about that investment to you?
Yeah, that was a lender-owned deal. It was owned by Fannie Mae. And it was sold at auction, and we bought that deal at around $40,000 a unit in a market that trades closer to $120,000, $140,000 a unit. So it was an incredible buy. And I think, again, those buys are out there right now. There are great distressed things to get a hold of.
So in your business, I'm assuming then, you know, with things like tariffs that make it more expensive, what is top of mind in terms of the risks then out there? For like what you guys are doing. You do have some visibility in terms of the build and then how that comes into the market and pricing, but I'm just curious.
Yeah. I mean, look, we don't know exactly what's going to happen with interest rates right now, right?
Yeah.
I think everyone's quite certain they're not going down anytime soon.
Yeah.
So there's always some sort of economic risk in that. We underwrite for higher interest rates.
How much higher?
So what we have been underwriting,
I'm curious.
We have been underwriting flat over the past couple of years because everyone was expecting drops, right?
Yeah.
So now we have to start pricing in. I would price in right now 50 bips, not knowing what's going to happen. But this is really about being very, very discerning as an investor, making sure that you're really underwriting conservative levels because we don't know exactly what's going to happen.
What's a deal that you pass on in this environment?
You know, I think that we're really lucky in an environment like this not to buy something that's overly physically distressed.
Yeah.
That we have the opportunity right now to take advantage of deals that maybe have outsized capital structure, and so they need some right sizing, but no, not fundamentally flawed.
You know, I want to go back to something you had said a little bit earlier, you know, that you're finding opportunities in the Midwest specifically. Tell us a little bit more about that. Like, what is driving that? I guess because we're in New York here.
Yeah.
You know, we forget about the Midwest sometimes.
Well, as did builders for a while. So, you know, you saw a lot of new construction in the Sun Belt and in certain markets that really started to build. And what happened was we weren't building as much in some of these other Midwestern different places. And so that is what created some rent growth in those areas because of that demand with the lack of supply. And
people are moving out. Is that what you're seeing?
Well,
moving
right
out
after
of
the
metropolitan
pandemic, we had a
areas
lot of people moving south. Right.
Yeah.
And moving out of metropolitan areas. And then now we're seeing that start to not necessarily fill in, but the demand is way outsized for the supply.
Since you play into workforce housing, I got to ask you in terms of the AI build, how is that? Is that impacting you guys? Are you thinking about kind of building or not building or acquiring or doing properties around that?
So it is definitely helpful where there are, new data centers being built or new, chip manufacturing plants or commercial growth related to AI. Anywhere around there, they're going to need employment, and so therefore they're going to need housing. So those are interesting things to look for.
Interesting, but you're not necessarily acting on it?
We're not necessarily buying dependent on that. We like to not be overly speculative, so we like to buy on fundamentals that exist today.
That's interesting, because you think that's speculative?
Well, it's how long does it take to get up and running? And it's what, generally speaking, if the project has already started, absolutely, sure.
Right.
Then you know what's going on. But when you're trying to guess where something's going to be built.
And, how long do the people have to live near the data center that are building the data center? Like, is that like a
I think that's a
kind
big thing we need to think about.
Well, that's also true. That's a really good point. And that is also one of the things driving up the cost of construction too. Now that you bring that
building
up.
out data centers.
Exactly. It's taking up the construction workers, right?
So true, right? It's all connected. Favorite market right now, just before we wrap up? Do you have a favorite?
I'm going to stick with Ohio today. But there's a lot. We love D.C. We love, we're looking a lot in Indiana. So all over the place.
Well, Tim's calling because he's in Ohio. So he would certainly appreciate that. His wife is from Ohio. Good stuff. Thanks for finding time.
Thanks for
dropping by. Amy Rubenstein, CEO of the Chicago-based Clear Investment Group, joining us here in our studio on a day when we've got markets. Yields are definitely popping up today. 4.69 right now on that 10-year yield. Flip it on over, though, to equities, and we're down.
Yeah, we are down. The S&P 500 down about 0.7%, and the tech stocks also kind of taking it on the chin here. The NASDAQ 100 down 1%. Small caps also getting crushed. The only risk asset in the green I see is Bitcoin.
I knew you were going to go there. Coinbase is the number one gainer in the S&P in the S&P 500 right now, and I think Strategy was the number one in the NASDAQ 100. So, some outperformance there. Hey, when we come back, how GLP-1s are reshaping so much in America. That's next.
It's 2:40 on Wall Street, live from the Bloomberg Interactive Broker Studio. I'm Matt Piper. Stocks still down at this hour with just over 1 hour left of trading. We do check the markets for you all day long here at Bloomberg. The Dow right now is down 634 points. The S&P is down by 57. The NASDAQ is down 290 points. Both the Dow and NASDAQ both down about 1.1%. The Bloomberg Dollar Spot Index is at 1193. Bitcoin is trading above 70,000 for the first time since June. Right now, it's up about 5% at $72,500. A rise in oil prices erasing some of the relief created yesterday from the Treasury Department. Brent is at just about $94 a barrel. WTI is at $87 a barrel. American consumers have not given up, but they're feeling the pressure. Walmart, which posted its weakest sales growth in more than 6 years today, primarily due to its pharmacy business, says consumer spending remains at consistent levels, even as customers make trade-offs to prioritize value. Target and Home Depot also reported sales gains this week. Let's see how shares are doing right now. Walmart is down 11 points. Target is just about mixed, just up 0.4%. Home Depot is down about 11 at this hour. A Boston area prep school is planning to borrow almost $35 million to upgrade its classroom and athletics facilities. That school, founded in 1866 to prepare boys to attend Harvard, called the Noble and Greenough School, taught the likes of President John F. Kennedy. Renovations will actually cost $70 million. That other half will come from philanthropic gifts, at least they're hoping. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Matt Piper, and that's a Bloomberg Business Flash.
All right, good stuff, Matt. Thank you so much. Matt Piper, he is in for Charlie Pellet on this Thursday. Hey, Wells Fargo today out publishing its first GLP-1 report.
There's so much money invested in these GLP-1s, so the banks have to get involved somehow.
Well, they do, right? And what's interesting is I feel like the last 3 years it's been AI and GLP-1s, and there's been certainly ups and downs, and the narrative has changed. Specifically, this report, it is their first of its kind from Wells Fargo. It's about how GLP-1s are reshaping America's health, spending habits, and healthcare system, Emily.
I thought this was a very interesting perspective because you hear a lot about how these weight loss drugs are impacting like what people are eating and like snack companies.
Clothes, if they're losing weight.
Exactly. But this is specifically on the healthcare system. So let's get into it. We're joined now by Robin Wenzel, head of Wells Fargo Industry Insights, with us from Minneapolis. Robin, great to see you. Thanks for joining us. Tell us about this report and why now? Why look into this trend right now?
Thanks so much for having me. It's great to be here. You know, one of the reasons why is we have a large healthcare practice, a dedicated team that specializes in it. And we like to make sure we stay ahead of a lot of the topics and conversations that impact those businesses. So for us, looking at GLP-1s, we've all certainly seen a lot of conversation around how it impacts consumer purchasing and grocery store sales. But we really wanted to dig in and understand the implications for the healthcare industry. And many of the things that we found were quite surprising to us.
Like what?
You know, I'll start with bariatric surgeries. If we look at the rate of bariatric surgeries between 2022 and 2024, we saw them decline by over 30%. And that was at a time where we saw GLP usage rise by about 120%. So bariatric surgery has really been a go-to for managing late-stage obesity and helping to bring that weight down. And when we look at the impact of GLP-1s, really a game changer in terms of results and being able to help people get that weight off in a very effective manner. So being able to use that pharmaceutical off-ramp to avoid surgery is certainly a nice outcome for many people. Conversely, though, on the other side, we do see people that were not able to get the bariatric surgery, but the GLP-1s are allowing them to get to a healthier weight that allows that surgery to be possible.
So great for people, right? But, you know, when I think about healthcare, great for people and great and probably extending their lives in so many different ways. But I do think about the impact, too, on like healthcare systems and hospital systems, right? If they're doing less surgeries.
Absolutely. And I think what we have to look at is understand that this is a long-term solution to obesity. So it can take time for these drugs to take effect, to have impact. So certainly a lot of the care that these patients receive will be ongoing. It's going to be a slow off-ramp for them. But it's also nice to be able to have some other solutions and open the doors for others who have been battling obesity and some of the complications with it. I think for hospitals, it's an opportunity to really change the game and maybe the profit centers for helping these patients. So it can become more about outpatient services, medication management, management of side effects, and really you're on these weight loss drugs for life. So the ongoing help and support to patients.
How are the drugs reshaping what pharmaceutical companies choose to pursue and do research on?
You know, that's a great question. And it's an interesting one. We can see that the late stage pipeline of pharmaceutical R&D is heavily weighted towards GLP-1s. And it's not necessarily just for obesity. We are seeing other opportunities coming out of these drugs and potential opportunities. One is the treatment of substance abuse, specifically alcohol abuse. And so we're seeing some research going into that. We've certainly heard about maybe some positive results around Parkinson's disease and dementia. So I think expanding and understanding these drugs and how they can help with other disorders is really a focus for some of these manufacturers.
Okay, I feel like, Robin, I'm the Debbie Downer here because I'm just going to go there. I've kidded with our reporter, Madison Muller, who has covered this space extensively and so smartly, but it does feel like this is the drug that can cure so much that ails us. Having said that, it's also a reminder that having extra weight or being obese is a problem for your health. It's a reality. And I don't want to get into how that can get people uncomfortable about criticizing that, but it's just a fact of life, right? In terms of your health. But the other thing, what I'm thinking about is how does the emphasis and stress on GLP-1s maybe crowd out R&D spending on other drugs that also need to be discovered?
So they're taking up a bigger share of the late stage R&D pipeline. That doesn't necessarily mean that they're taking up dollars. So we can see that GLP drugs have outpaced oncology, as a percentage of R&D spend. But that doesn't mean that those dollars towards oncology have diminished. In fact, they haven't. So I think what we're seeing is that we have a very widespread problem, specifically here in the US, with 40% of US adults classified as obese. It's a medical diagnosis. And so finding treatment for this population, as you said, it's all aspects of their health. So there's a cardiovascular element to this too. So it's really not just a weight loss drug, it's a cardiometabolic drug. And so it can be a game changer towards the health and prevention for many, many people, impacting several that can benefit from this drug and enjoy a much healthier life.
I've seen it directly, impact people, and just they are so much healthier, and it's just their outlook and situation is so much better.
Yeah. I mean, Robin, this is pivoting a little bit, but I do want to ask, what are the investment implications from this report? What do investors need to know?
I think we're looking at a situation where it's heavily weighted towards these drugs. And so any sort of disruption that could happen, supply constraints, those would ripple through and they would have an impact maybe broader than most people would expect. I do think there's a lot of research still to be done. And so the fact that there's money and capital going into it is a good thing. The other good thing is we are seeing the results. And so it is very promising in many areas. I'm encouraged by the investment. But I would just caution that it could have some larger impact should any hiccups happen along the way.
One of the things I wanted to ask you, like orthopedics or something like that, where losing weight or being slimmer can be better on your joints. It's not so much stress and so on and so forth. So maybe there's less demand for surgeries or so on. But at the same time, if GLP-1s, which is a good thing, is enabling folks to live longer, and being a drug that's so productive in helping a lot of different things that certainly age an individual, that might orthopedics benefit because we're just around longer and we're going to all need kind of an overhaul.
Yeah, I think it's an excellent point. And I don't think the data has settled on that yet. So, on one hand, one of the side effects of long-term obesity is that wear and tear on the joints. It's the knee replacement, the hip replacements. If we're able to prevent the weight and keep the weight off, that could, in theory, reduce the need for those extra interventions. However, as you point out, you become healthier, you lose weight, you can become more active. We can see a whole new slew of runners out there,
right?
And people embracing, exercise. So it's a mixed bag. And I'll go back to the other opportunity that weight loss presents. Again, people who wouldn't otherwise qualify for the surgery, now it opens the doors for them as well by allowing them to lose weight and get a little healthier.
Yeah, no, I love this. I love this deep dive. Thank you so much. Really, really appreciate it. Robin Wenzel joining us. She is head of Wells Fargo Industry Insights, joining us from Minneapolis, their new report about how GLP-1s are reshaping the business of healthcare. All right, we want to get to our next segment because it's really about, Emily, old finance and I feel like new increasingly coming together.
Yeah, Intercontinental Exchange, the parent of the New York Stock Exchange, is looking at Polymarket's new funding round.
Right.
Of course, the prediction markets betting platform. And this is after investing more than $1.6 billion in that platform.
Yeah, our own Tyler Kendall of Bloomberg spoke with Intercontinental Exchange Chair and CEO Jeffrey Sprecher in a Bloomberg exclusive.
Polymarket is looking to raise capital at a $20 billion valuation. So I was wondering if you were going to add to your stake or keep it capped at, I think, $1.6 billion.
Yes, we're in at $1.6 billion. We'll look at it. If it will help the round in order to have our imprimatur on it, we always are interested. We've done 2 rounds with them. But the reality is we're not a venture firm. We're really here to have this transfer of information and expertise.
I did want to ask you, because you're looking at creating a futures market when it comes to AI compute power. Why do you think that this is the right financial tool for lenders or these tech companies in the AI space to hedge against their costs?
It's a good question. First of all, the CFTC is going to do a broad, information gathering about that very question to see where the whole industry is, which will be interesting. We are the world's electricity market. I actually started the company to be an electricity exchange, so it's in our DNA. And if you think about compute, today it's electricity and possibly chips on the input, and then on the output, these things called tokens, which is basically the way you pay for compute. And so somewhere in that amalgamation, I suspect is going to be trading and risk transfer, whether it's buying the inputs to the power plant and data center, or whether it's buying the output, how the models work, I think is something that we'll discover with this inquiry.
Well, the CFTC chair just told me that he seemed rather excited about this idea. So I'm curious, have you gotten any indication when it comes to the timeline for this? Have you had to push back a timeline? When are you planning to, if you get that regulatory approval, to move forward?
Yeah, we've announced that we intend to do this at the same time the CFTC has announced that they want to do this survey. And so we think they're going to be relatively efficient and quick. And it will nest with the timeline that we will have for launching. But we're also interested to see what the market thinks about these ideas. Will the hyperscalers want to hedge? Or that's not historically where they go. We've seen some of the hyperscalers and foundation model people are starting to advertise for trading to get personnel in there. So it does feel like, there's something to this, but I think we'll know, within the next maybe 90 or 120 days.
Well, I was going to ask, what type of clients have expressed the most interest in this?
It's everyday people, honestly. It's,
really?
All about, like my company is, had a zero budget for tokens for 2026. And now we're a big shop with most of the foundation models operating. Our costs are going up. We're trying to figure out what's the return on investment. And every CEO I talk to, and we talk to a lot of them because of the New York Stock Exchange, is going through this process of am I going to use one of these big foundation models? Am I going to use an open source model or open weight model? Which cloud am I going to be in? So those are all, issues that business is wrestling with right now. And we're wondering, is there a way that we can help them by having a risk transfer through hedging?
If I try to streamline this to news of the day, and we talk a lot about the AI build out in Washington, we also talk a lot about the conflict in Iran. And whenever there's updates, the markets are just watching it so closely, because when news breaks over the weekend, or any events related to the energy markets, there is notable trading in these offshore platforms when it comes to 24/7 oil futures. What is your level of concern with these products, and are you seeing any direct impact?
We're watching it closely. Maybe that's the political way to say it. The energy industry itself is not set up to trade on weekends. The banking system is closed.
Yeah.
And so if there is a high price spike up or down, there just isn't the infrastructure right there to manage the risk on the weekends. So let's call it institutional money is not there yet for 24/7, 365. That said, part of what's going on, underneath this is this movement towards blockchain, which is really just a rewiring of a banking system. It's really just the ability to move money on the internet 24/7, 365. And I do think that that's either going to urge the banks and the Fed to open the Fed funds wire and keep it open around the clock, or we're going to have alternative rails through blockchain. One of those two will happen. And when that happens, then I think you'll see 24/7, 365. It's in that vein that we want to extend the hours of the New York Stock Exchange, tokenize the settlement of the New York Stock Exchange. It's not so much about the stocks as it is about, can we get capital movement underneath, because you have to spend money to buy the stock.
So are you seeing demand for 24/7 futures just more generally?
We definitely see these things called perpetual futures, and and they started actually around energy, but they've moved quickly into equities, and so it does feel like that's a 24/7, 365 equity movement.
Yeah.
There's a lot of pre-IPO trading. There's a lot of trading of the big notable tech names. People in Asia and other jurisdictions want access to these U.S. stocks. The good news is the United States dominates tech. And so in order to serve that clientele, you're going to have to be open when a lot of Americans are in bed.
So are you considering offering perpetual futures on ICE's own exchanges?
Not necessarily. Our client base is really a hedging client base, and there's no forward pricing curve that is created by a perpetual future. It's really a speculative. One person thinks it's going to go up, and the other one thinks it's going to go down, and so you have a red-black bet. And obviously there's a lot of interest in that, but it doesn't cater to our distribution or client base. So we know the people that are doing this. Obviously, you mentioned Polymarket is working that direction, and I think we'll probably partner with people or help other people who have distribution that we don't have.
All right, that of course is the CEO of Intercontinental Exchange, there with our own Tyler Kendall. That's a Bloomberg exclusive. And it just is interesting to me, Emily, and I guess something that probably has been on your radar, and just kind of the old and the new. Increasingly, at first, sometimes I feel like there's like, no. And then it's like, wait, we got to look at what these guys are doing.
Well, I mean, I think a really big element here is that cryptocurrencies, digital assets trade 24/7. Mm-hmm. And now those worlds are coming together, like you said. And people are like, well, maybe we should trade stocks 24/7. Personally, I like an open and a close.
I like an open and a close.
I like that vibe of, okay, it's 4 o'clock. Let's go home.
I also am interested in like how much volume would there really be, right?
Yeah.
On those off hours. And I don't know, does that really provide a more efficient marketplace? I don't know.
And Tyler Kendall asking the hard questions. I mean, is there really demand for this here, you know?
Yeah, I think it's just hard. I think everybody's watching, and we'll see kind of the regulatory oversight of all of it and how it becomes almost more traditional, or I don't know, I guess, right? Stay tuned on this one. I just, it's fascinating how much we're talking about the prediction markets and other things.
Yeah. Digital finance.
Right? Digital finance.
Becoming mainstream.
Yep, increasingly. All right. Check out that full interview that Tyler did with the ICE CEO. You can find it, of course, on the Bloomberg and at Bloomberg.com. Do not go anywhere. Lots to come in the next 2 hours on Bloomberg Businessweek Daily. Emily and I will guide you through that. But if you're watching on TV, the close starts right now.